From an outside perspective, the stock market seems complicated. It's often portrayed in movies as a way of getting rich, and yet nobody ever teaches us about it. At school, you learn how to calculate the area of a triangle, but not how to invest your money or what the stock market even is. And then you hear stories of everyday people making money from it, and you wonder, is it really that easy? Am I missing out? How do I even buy stocks in the first place? And so, maybe you've searched about the stock market before, only to be bombarded with charts and technical terms that seem like they're from another world. However, here's the reality. Anyone can invest. It's not as complex as it sounds, and there's no minimum amount of money you need to get started. So, let's delve into the real truth about making money with the stock market. Let's say you start a business. Since you created it, you own 100% of it. But in order to scale it quickly, such as opening more offices or hiring employees, you're gonna need some money. And one of the most common ways to get money quickly is by selling shares in your business, which means giving away some of your 100% ownership in exchange for money up front. And that's all a share really is. It's a piece of ownership in a company. But of course, many business owners are happy to sell some shares in their company so they can raise more money, because that will allow them to build a much bigger business that's worth a lot more. And on the other side of this trade, many investors are happy to buy shares in companies because they believe the business will succeed and be worth a lot more in the future, meaning they can sell their shares for a lot more money than what they paid for them. However, here's where the business owner has a choice to make. Because there's two different ways a business can sell shares. Option 1 is selling the shares privately. If you've ever seen a show like Shark Tank or Dragon's Den, you'll have essentially seen this in action. This is where you make pre-arranged deals to sell shares in your business to specific investors. But then there's also option 2, which is to sell shares in your business publicly, meaning anyone can buy them. And this is where the stock market comes in. The stock market is simply a place where anyone can buy and sell shares in businesses who have opted to sell their shares publicly. Now, the actual terms stocks and shares are sometimes used interchangeably to mean the same thing, but generally speaking, a stock refers to the actual company. For example, you may want to buy Amazon stock, whereas a share refers to the smallest individual piece of a company you can buy. For example, you could buy 1 share of Amazon stock. In fact, most big companies you can think of are listed on the stock market, meaning you yourself can pay to own a very tiny fraction of those businesses yourself. Apple, Microsoft, Netflix, you name it, you can get yourself a piece of these companies by buying their shares. Now, why would you want to own such a tiny fraction of a company? Simple, to make money. The idea when you buy shares is that you believe at some point in the future the business will be worth more, which will mean your shares will be worth more, and therefore you can sell them for a higher price than you initially paid. The difference between the amount you bought them for and the amount you sell them for is your profits. So, clearly the goal here is to buy when the price is low and then sell when the price is high, which leads us to a new question. The simplest answer for this is supply and demand. The only way you can buy a stock at a certain price is if someone is willing to sell it at that price. And likewise, the only way you can sell a stock at a certain price is if someone is willing to buy it at that price. Whenever a buyer and seller agree on a price, a trade happens. When you look up the current price of any stock, what you're actually seeing is the most recent price that a buyer and seller agreed on. But here's the thing, there's a lot of different factors that can influence supply and demand. Firstly, if great news about a company is released, such as an exciting new product is launched, or they release their financial results and they're better than expected, these kind of things can cause a sudden price rise. This is because people are now more confident in the company and its future. As a result, more people want to buy the shares, whilst the people who already own the shares are now less likely to sell them. So there's higher demand, but lower supply, which is why the price increases, because more people want to buy the stock than sell it. For example, let's say you own shares of company X, which just announced record profits. Maybe before that news, you'd have been happy to sell for $10 per share. But now you can see how bright the future looks for company X. You and most other shareholders don't want to sell for $10 anymore. So buyers are going to have to pay more to convince you to sell your shares, thus driving up the price. However, the reverse of this is true as well. If people lose confidence in the company, for example, if they're getting a lot of negative media attention or a new government policy is going to affect the sustainability of their business, the price could easily drop quite quickly. This is again down to supply and demand. After this bad news, the people who own the stock may want to get rid of it, whilst not as many people are queuing up to buy it, so the price falls. And so the current price of a stock can often give you some indication of how the business is currently doing. But remember, it's not the full story. A good example of this is Tesla. Some stock market analysts argue that based on its fundamentals, meaning things like how many products it's selling, the profits it's making, and so on, Tesla's price should be lower. However, a lot of investors keep buying more of the stock and refusing to sell their shares because they believe in what the company's doing long term and the vision that Elon Musk has for it. As a result of that confidence and belief, the price remains relatively high because ultimately it is supply and demand that controls the price. An even more extreme example of this was in the dot-com bubble, when the internet was still new and exciting and people were throwing money in at almost any company with a website. The problem was, there was so much demand and hype, people kept buying more and more shares in these internet companies, even though many of them weren't even profitable. And eventually reality caught up, the prices crashed, and the bubble burst. Now, so far we've been thinking of the stock market as one big entity. But technically, there are lots of different stock exchanges all over the world. In America, there's the New York Stock Exchange and the Nasdaq. In the UK, there's the London Stock Exchange, and so on for other countries. You see, when a company starts selling its shares to the public in an event called an initial public offering, they choose which stock exchange they want to list their company on based on which one's most relevant for them. Back in the day, this was a much bigger decision because these stock exchanges were physical locations that people actually went to, and they bought shares in person on the trading floor. You would then get a physical stock certificate for your purchase. But nowadays, thanks to the internet and technological innovation, people can buy shares online from home from any of the different stock exchanges worldwide. You don't even have to speak to anyone, and there's an electronic record of your shares rather than anything physical. Now, the most common way people do this is by using a free trading website or app. In the US, popular places to do this are Robinhood and Webull. In the UK, there's Trading 212. And no matter what country you're in, a quick Google search will reveal a similar equivalent. In fact, if you check out the description below this video, I'll put some links to these different platforms that will give you some free stocks when you register. Even if you aren't going to invest any money right now, you may as well still get these free stocks. But then once you register, you'll be able to browse all the stocks available and start investing. Now, whilst every platform may look slightly different, the main features are always the same. Firstly, next to each stock, you will probably see the stock symbol, also sometimes called a ticker symbol, which is simply an abbreviation of the stock's name. For example, Netflix is NFLX. If you click on a stock, most platforms will then give you some kind of graph to show you how the stock price has changed. If you don't have this, then you can just search the company's name plus the word stock on Google, and you'll get the exact same thing, along with the option to change the time period on the graph. The next thing you'll notice within your trading platform is that when you come to actually place an order, it will ask you several things. Firstly, it will ask you if you want to buy shares, or if you already have some shares in that company, it will ask you if you want to sell them. Secondly, it will ask the quantity. How many do you want to buy or sell? And finally, it will ask which type of order you want to make. The simplest type of order is a market order, which simply means you want to place the order immediately at whatever the price is right now. Due to the quick fluctuations of the market, you may end up with a slightly different price, but it should be very close to the current price you see. And so a market order is just like a normal order you'd make online on any other website. You want to place it right now for the price that's on screen. However, what's often much better is to place a limit order. What this means is that you won't buy or sell the shares until a certain price is reached. For example, if you bought some shares that cost $10 each and you want to sell them for $20 each, you can set a limit order for this. That means you don't have to constantly check the price and remember to sell them when the price goes up. The trade will happen automatically once the share price reaches whatever price you input. It's the same with buying shares too. Rather than just buying at the current market price, you could set a limit order to buy the shares for a lower price, and the order will happen automatically once the shares fall to that price. Of course, the risk with a limit order is that the price you enter never gets reached, so the order never actually happens. So a limit order is really just you asking the trading platform to place the order on your behalf if the shares reach a certain price. So, armed with that information, you are now able to go and buy and sell stocks. However, before you rush to start investing, there's several key things you need to know when it comes to actually making money from the stock market. When people talk about the stock market, there's actually several different types of trading that's happening, each of which is very different. The first of these is day trading, which is where you may buy and sell a certain stock within a very short time period, sometimes hours or even minutes. And whilst it's true you can make a very fast profit from these kind of trades, it's also true that the vast majority of people lose money by doing this. Research suggests that 80% of all day traders quit within the first 2 years, and some studies suggest only around 1 or 2% of people are successful in the long term when trying to day trade. So, a second type of trading is to buy shares in companies you believe in more long term, and then holding those shares for months or even many years, because you believe that over time the company will grow and thus the share price will increase as well. One of the most famous investors of all time is the billionaire Warren Buffett, and this long-term strategy is what he uses. But it's worth noting that the reason he's been able to make so much money from the stock market is because he meticulously researches companies, looking through all their financial reports and plans to try and find companies he feels are undervalued, meaning the current price is lower than what he thinks it should be. The problem is, for the average person, being able to do that level of in-depth research and analysis is not just difficult and time-consuming, it's nearly impossible. Especially because you're competing not just with individual traders, but with big hedge funds who have whole teams of analysts to research this stuff on a full-time basis. This is why some people get a stockbroker to do the research for them. But that's still very risky. Warren Buffett actually has a great quote on this, which is that Wall Street firms have made their fortunes selling services rather than making good investments. Instead, there's actually a third type of trading that's typically far more profitable and much less risky, and that is index funds. Imagine for a moment that instead of you having to research companies and try to figure out which to invest in, you could simply invest in all the top companies at once. That's essentially what an index fund is. Some of the most well known are the S&P 500, which tracks the stock performances of the largest 500 companies on the US stock exchange. Or the FTSE 250, which tracks the largest 250 companies in the UK. There are many others as well, but let's just say you decide to buy one share of the S&P 500. What you're essentially doing there is splitting your money into the top 500 companies in the US. And it's just as simple and fast as buying an individual share of a company, except with these index funds, you can diversify by by investing in all the top companies at once. So let's talk money. With an index fund, the average annual return is generally between 6 to 10%, which may not sound like a lot. But contrast that with a traditional savings account, where you may well be getting less than 1% interest. The unglamorous truth is that index funds are the most reliable way to make consistent money with the stock market in a very passive way. You can simply set it so you invest a certain percent of your income every month and then just leave it to build. And if you do that at a relatively young age and keep getting, say, 8 or 9% returns each year, that money will compound and grow substantially over time. Now, maybe that's not what you're looking for. With every investment, it all comes down to risk versus reward ratio. Index funds are much lower risk than investing in a single stock because you're diversifying your investment and not putting all your eggs in one basket. But if you did invest in individual stocks, whilst the risk may be higher, the reward is also likely going to be a lot higher if it goes well. So only you can weigh up what risk versus reward ratio is better for you. However, I will leave you with 5 final things to consider that will hopefully be very helpful. But first, I want to tell you about today's awesome video sponsor, Skillshare, an online learning community with thousands of inspiring classes for creators. There's also great Skillshare classes from other YouTubers you may know, such as Context is Key by Gary Vee. And Skillshare are always launching new premium classes on a wide range of incredibly useful topics. The first 1,000 people who use the link in the description below will receive a 1-month free trial to Skillshare Premium. So just click that link below to get started. Number 1, don't invest on impulses and emotion. A lot of newcomers buy based on FOMO when they see a price shooting up, and then panic sell when the price drops. But remember, until you sell your shares, you haven't lost money. As long as your feelings about the company haven't changed, then if anything, it's better to buy when the price has gone down, or in other words, buying the dip. Number 2, with any investment in the stock market whatsoever, only invest what you can afford to lose. This is why it's recommended to invest a percent of monthly income and keeping a separate emergency fund and savings for if you need quick access to the money. Because over a long enough time period, the market always bounces back, which is why index funds can be great if you don't need that money for a while. But there will be some dips along the way, which is why you need to have a separate source of money in case you need it. Number 3, be wary of scammers offering a guaranteed way to make high returns from the stock market. If they really knew how to make so much money from stocks, they'd be investing all their money into that instead of selling you products or services. It's the same with groups trying to tell you that you should invest in a specific stock. Quite often, they're just trying to pump up the price so they can dump their own shares for a profit. So, whilst you should absolutely listen to a wide mix of sources for news and opinions, remember that ultimately, nobody can perfectly time the market. Number 4, if you do have a lump sum of money that you want to invest into the stock market, it's generally considered wise to dollar cost average, which essentially means instead of throwing it all in right now at whatever the price is, spread the investments out more gradually over a few weeks at least. That's because if you put it all in right now, it could be at an exceptionally high price today, so spreading the investment out will generally give you more of an average price. And finally, number 5, whilst there are risks, investing is not the same as gambling, because investing increases the overall wealth of the economy. You are literally investing in something that's creating more value and wealth. So I personally wish more people were introduced to the stock market, especially at an earlier age. It may not make you rich, but it can definitely be a very reliable way to save and invest your money. Phew. Okay, so I realize this video may seem slightly overwhelming at first, but if you go back through the relevant sections, hopefully you will see that investing is no longer just for the rich. Anyone can invest and make money from the comfort of their home, and it's actually not that complicated once you get started. Just always make sure you're investing with a risk versus reward ratio that you're comfortable with. And if this video was useful for you, please consider hitting the like and subscribe button for our almighty overlord, the YouTube algorithm. And then feel free to check out these videos right here for some more money-making tips and documentaries. I'll see you next time. Cheers.